Chapter 11 gives you a simple, practical checklist you can use to decide quickly whether a stock is worth deeper study. Peter Lynch calls it the 2-minute drill, a short monologue you should be able to deliver from memory that explains why you like a company, what has to happen for it to succeed, and what could go wrong. If you cannot explain the story clearly in a couple of minutes so that even a child could follow it, you do not understand the investment well enough to buy. The drill builds on the groundwork you already have. You should know the category of the stock: slow grower, stalwart, fast grower, cyclical, turnaround, or asset play, and roughly where the price stands relative to earnings. From there, you boil the case down to the essentials. What is the growth engine? How sustainable is it? What are the chief risks? Who stands to lose or gain if the plan works? And which simple facts you can check going forward. Lynch gives short templates for each category, so your 2-minute script has structure. For a slow grower, you focus on the dividend history and whether the company has raised payouts through past recessions. For a cyclical, you explain why the cycle is turning. For example, stronger sales, inventory drawdowns, and plant shutdowns that should produce higher profits. For an asset play, you list the hidden assets, estimate what they are worth, and show how the market price compares to that asset value. For a turnaround, you describe what management has done to fix the business and whether early signs show the cure is working. For a stalwart, you explain whether the price-earnings multiple is reasonable and whether anything new is accelerating growth. For a fast grower, you identify the niche, the plan for rolling out more locations or finding new customers, and the balance sheet strength that lets it grow without falling into distress. 2 extended examples make the method concrete. The first is La Quinta, the motel chain. Lynch did the drill. He traced the business model, found the niche, and tested every practical detail. La Quinta had trimmed costly hotel features, outsourced food to independent restaurant operators rather than running its own restaurants, built smaller 120-room inns that cost less to construct and could be managed more cheaply, and targeted business travelers who would book in advance. Management was repeating a proven prototype in several markets. The company was growing at about 50% a year. The debt load was reasonable. Insiders and a few analysts were not crowded in, and institutional ownership was low. Lynch also did an experiential check. He stayed in several La Quinta properties and inspected them himself. All of that turned his 2-minute script into a confident buy, and La Quinta became a large winner. The second story is a warning. Bildner's, a specialty food store. Lynch had the local edge. He loved the sandwiches and bought into the initial public offering. But he missed an essential question. Does the successful prototype replicate well outside the original neighborhood? Bildner's expanded into department stores and new cities too fast, opened outlets that flopped, and exhausted its financial runway. The prototyping had not been proven at scale, and the company overreached. The stock collapsed and produced heavy losses. The takeaway is plain. Good local economics do not automatically translate into a scalable public company. Always ask whether the idea works elsewhere, whether there are enough competent managers to run new locations, and whether the capital plan is conservative enough to survive early mistakes. Lynch emphasizes 2 practical habits tied to the 2-minute drill. First, spend the time to develop the story properly. Sometimes that is a quick conversation, and sometimes it is several hours of homework. Second, use the script to monitor progress. List a few measurable milestones you can check periodically, such as unit openings, same-store sales, margin trends, insider buying, or reductions in debt. If the facts stop fitting the story, reassess or sell. If they continue to fit, you can add with confidence. In short, the 2-minute drill is a discipline that keeps you from buying on a tip, a catchy product, or a single good meal. It forces you to turn an initial idea into a testable investment thesis. What must happen, how likely it is to happen, and how you will know if it is happening. When you can say all that in plain language within 2 minutes, you have earned the right to invest.